Greetings, Shaun Pruitt here, Zacks equity strategist, and today I'm going to be discussing stocks to watch for a rebound amid September rate cut hopes. So with investor sentiment remaining high following Federal Reserve Chair Jerome Powell's reconfirmation that a rate cut could be ahead as soon as September, several stocks may be poised for a sharp rebound from various sectors where companies are sensitive to borrowing costs, capital market activity, and consumer demand. So keeping this in mind, here are 4 stocks that investors will want to pay attention to from the consumer discretionary, construction, and tech sectors. So the first stock is Comcast, ticker symbol CMCSA, and this is from the consumer discretionary sector. So although telecom and media companies are generally less cyclical and less sensitive to interest rates, it's no secret that they tend to carry high debt loads, which can be softened by lower borrowing costs. And Comcast is a prime example of this, having over $95 billion in long-term debt at the end of Q2, as you can see here. And lower interest rates could certainly reduce its refinancing costs. So this debt management scenario could vastly improve investor sentiment for Comcast stock, with CMCSA still hovering near its 52-week lows of around $31 a share. And to that point, lower interest expenses should mean more cash for buybacks, dividends, and strategic investments, which are certainly needed considering the drop in Comcast stock has also been attributed to its internet broadband subscriber losses and streaming uncertainty. So that said, it's noteworthy that Comcast checks the box as a defensive stock that could have plenty of upside at some point, with the company exceeding the Zacks EPS consensus for a remarkable 34 consecutive quarters, as is illustrated in this price consensus and surprise chart below. But more intriguing is that CMCSA trades under 8 times forward earnings and currently offers a very enticing 3.87% annual dividend yield. So there you can see that impressive EPS streak of beating earnings expectations for Comcast, but the stock is still stayed depressed just because of the lower subscriber numbers and the high debt load that we just discussed. So the next stock is Century Communities, ticker symbol CCS, and this is out of the construction sector. So, of course, lower interest rates reduce mortgage costs and can unlock housing demand, with Century Communities being a notable home builder stock that can be in store for an extended rebound. So as a leading developer of single-family residential homes, Century Communities stock is 40% below its 52-week high of $108 a share, and it's starting to stand out in terms of value at a reasonable 12.5 times forward earnings multiple and less than 1 times forward sales. So correlating with what is projected to be a more favorable operating environment, Central Communities should see a sharp rebound on its top and bottom lines in fiscal 2026. But what further separates this home builder stock from many of its peers is that CCS offers a 1.72% annual dividend yield. So generating solid cash flows from high demand and rising home prices during the post-pandemic housing boom, Century Communities introduced its dividend in 2021, as you can see here, to signal confidence in its financial stability and commitment to returning capital to shareholders. And furthermore, with a payout ratio of under 15%, Century Communities can comfortably afford to offer dividends while having enough leverage to focus on its growth as well. And you can see that dividend is well above its industry average. So a nice dividend stock there, especially with its growth in recent years. And that should return, especially if a rate cut is ahead. So tech stocks, Adobe, ticker symbol ADBE, and Intel, ticker symbol INTC. So discretionary spending by consumers and enterprises is boosted by lower rates and often improves valuations for growth-oriented tech firms, with Adobe and Intel being 2 of interest in particular. So lower rates will make it easier for Adobe to fund its aggressive initiatives in AI and mobile expansion. And this AI integration across Adobe's Creative Cloud and Document Cloud is actually driving new use cases and subscription growth. And ADBE is still trading 38% from its 52-week peak of $587 a share. So reductions in borrowing costs are very appealing for both of these tech companies, especially Intel, after posting its first unprofitable year since 1986 last year, with negative $18.8 billion as far as its unprofitability. And Intel's AI endeavors as a chip maker will be propelled as well. And this follows the recent announcement that the U.S. government has taken a 10% stake in the company. So there goes your capital market activity. And this also follows SoftBank's $2 billion investment a few weeks ago as well. And the government is converting funds it issued through the CHIPS Act grants into equity. So while Intel stock has started to edge closer to its 1-year high of $27 a share, INTC is well off its multi-year piece of $50. So the bottom line here is that a September rate cut by the Federal Reserve is expected to ripple across various sectors, with Comcast, Century Communities, Adobe, and Intel being primary examples of companies that could benefit exponentially. Again, I'm Shaun Pruitt, Zacks Equity Strategist. I hope you enjoyed this content. For more, please feel free to visit zacks.com/promo.